Good afternoon, everybody. I welcome you all in this series of webinars which are being conducted by the Goods and Service Tax Practitioners Association of Maharashtra. Today in this series, we shall be having the webinar on the topic Impact of Foreign Trade Policy on Indirect Taxes. We have already had a few webinars in this series, like the first one was on hotels, restaurants and caterers. The second was on the works contract transactions. Then we had on tours and travel industry, and I think that webinar was very much looked into by various participants all over the country, and still we are getting various views on that webinar, which was then put up on the YouTube channel of GSTPAM, and it has crossed more than 1,200 views till now. I should really compliment our convener Hiral Shah, who has been very actively taking up this entire webinar series and ensuring that all this knowledge sharing is also given to the members of GSTPM, and this knowledge sharing sessions are uploaded on the YouTube channel of GSTPM also, and really benefited. These webinars are benefiting a lots of members and lots of dealers all across the country. Well, friends, the topic, the foreign trade policy and its impact on indirect taxes. It's not a topic which is very much looked into by the day-to-day practitioners who are looking after the GST of their various clients, but it's a very important topic in the sense that there are various incentives available. Earlier, we had the DPP scheme. We as practitioners know that when a DPP license is sold, there is some VAT payable on that. But that DPP has now been replaced. Now we have the MEIS and the SEIS. That is the merchandise export incentive schemes scripts and the service export incentive scripts. I think there is not much awareness about this. Secondly, there are also aspects which relate to SEZ units, free trade warehousing zone units, EOU units, advanced authorization. I think there are various topics which are linked to this foreign trade policy, and which have an impact on the planning of the companies, on the taxation of the companies as far as the indirect taxes are concerned. And to guide us on these aspects, we have CA Jigar Doshi. I welcome you, Jigar, for this webinar, and I'm sure that the participants will be really benefited by the knowledge sharing which Jigar will be doing. I'll now request our convener, CA Hiral Shah, to briefly introduce CA Jigar Doshi.
Thank you, Pranav bhai. Welcome, Jigar bhai. Jigar Doshi leads the SKP Group India and UAE Indirect Tax Practice. He's a chartered accountant by qualification and has over 13 years of extensive work experience in the field of indirect taxation. His domain of expertise includes Indian GST, Indian customs, cost-wide indirect taxes, and UAE VAT legislations. Jigar's vast experience enriches him with the knowledge of operation of various global indirect taxation laws, and hence, as a part of the profile of the SKP Group, he is pivotal in establishing presence on VAT front in other GCC regions as well. Some of the speaker's credentials include being a part of the 15-member Indian group of ministers meet for simplification of Indian GST return process, trained over 1,000 Indian government officials, and empaneled trainer at National Academy of Customs, Excise and Narcotics. Indirect tax structuring and implementation of GST and UAE VAT laws for business companies across pharmaceutical, banking and financial institutions, IT, poultry, aviation, marine equipment, travel tourism, real estate and logistics sectors. He has assisted various law firms in implementation of GST and UAE VAT laws in their businesses. He is regularly writing and speaking for various journals and online forums, including international forums. Associated with various trade bodies, foreign embassies and associations, for speaking engagements and training on GST and UAE VAT laws. Thus, all of us would realize that from this brief background that we have an expert faculty to explain us on the applicability of foreign trade policy to indirect taxes. Before handing over the charge to Jigar Bhai, I would request CA Pranav Kapadia to kindly hand over a small memento.
Thank you so much.
Thanks for sharing your time.
Thank you.
Now the charge is entirely
Over to
yours.
Jigar Bhai.
Over to Jigar.
Yes.
Thank you so much, Pranav bhai. Thank you for this opportunity. It's almost very good to talk about something which our fraternity is still working hard on, and we all are aware about basic thing that foreign trade policy is something which is not very focused, and it is always good. I'm very sure with through this webinar we are going to spread a decent amount of knowledge from where we are today right now, and also it will lead to opening up our minds on how we can help our clients from various perspectives. And
Advisory point of view, it will help a lot.
Correct, advisory perspective, and with the economy going up and down, by talking to our clients directly, helping them on the bottom line is something which always will be beneficial from our fraternity perspective. So thank you for giving me all this opportunity. I'm very sure it should rather help from the CA's perspective. And thank you, Hiran, for such a vast and detailed profile. I'm myself shocked that this all information we are possessing. Thank you for the introduction and helping me out to do this webinar. With this, I start, participants. Can we just have this minimized? Can we have this? If he put this in a yeah, put it down.
It's minimized.
That's the best. I'm not shutting it down.
Just pull it.
Sure. Right, thank you so much. So we have, friends, a few topics to discuss. I've tried to play well in the 1 hour that we are having. The plan is to talk about this topic for almost 1 hour till 5 o'clock, and we also have a Q&A round once I'm done with the presentation, so that you can please put your questions in the chat box. I hope I will be able to answer, and even if we are not able to answer because of time or the technicalities around it, we would come back to you over an email. So please put your email ID and the question on the chat box whilst the presentation is on. I'm going to consolidate all the questions together and try answering them after the session is over at 5 o'clock. Start with the first very basic concept, foreign trade policy. So we all are aware about the fact that GST or any taxation is ruled under the umbrella of Ministry of Finance. But the foreign trade policy is run under the Ministry of Commerce. So Ministry of Commerce is a body which is planning or intending to increase or have a clear facilitation between the trades and more focus towards ensuring that there are import policies and export policies in India for their development of the country. And through this ministry, the foreign trade policy gets announced, which is a provision under the Foreign Trade Development and Regulation Act 1992. The policy typically is for 5 years, and there is always a midterm review which happens, which validates what policy states and what intends within the policy should be continued, or there should be any amendments to be given. The recent FTP is Foreign Trade Policy of 2015-2020, which was reviewed in the midterm. The midterm review was slightly delayed because of various reasons, including one of them was GST. But the final midterm review was done in the December 2017, and FTP 2015-20 was validated So the current FTP stands as a policy 2020, and the governing body or the authority, the way we talk, is the Director General of Foreign Trade, which is DGFT. DGFT is the authority who will be the person, issuing the scripts, or the body who will be looking after the various aspects of the FTP. One also has to remember that FTP is a policy. So anything which is coming through the policy directly by Ministry of Commerce will also have its ramification around the laws. So any impact, for example, what Pranabhai was saying, that we saw DEPB and we saw VAT applicability on DEPB. Similarly, there are other scripts which we are going to talk about, whether GST is applicable on it or not, whether what kind of taxes has to be paid, has to be looked out from the GST notifications. So this is a policy, and then entire rule-based activity will happen from the relevant laws. For example, GST applicability on any scripts. So the 5-year policy is valid. 2020 is the year we have to focus about, and the future will be again decided at that point of time whether the extension or the new policy will come up or not. One of the relevant aspect which on this slide I would like to highlight, which as professionals we need to know, is the fact that the foreign trade policy, while it is very relevant for a country like India, there are various developed countries who are not in favor of having such kind of policies. It is at the global level which is getting discussed whether promotion of some kind of activities such as export should be done from any countries or not, because it is not a free trade between the countries or globally, and hence benefiting the countries which are benefiting always going to benefit more vis-a-vis the countries who are developed and not having such kind of policies. So at a global level, there is a huge discussion and debate happening on whether such kind of policies are good and valid globally, not locally at any country level. So a decent amount of discussion is happening around, specifically from the developed countries like US. That's the background of the foreign trade policy. Obviously, the objective which has been mentioned below is very clear, that there has to be of ease in doing business and the trade facilitation, which is going to be the major objective of any FTPs. To start with, talking about any scripts or any policies or any benefits which are going to be discussed in future, the very first thing that we all are per se aware, but there are few important pointers which I would like to talk about, would be within the importer-exporter code. So to have per se, in a very simplistic manner, to have any policies obtained for any client, it is most important for us to have our clients applied for IEC, which is importer-exporter code. A thought process is always driven in our professional world that if you're an importer, you need to have a IEC code. But we have to remember that the law is very clear. If even you are into an export business, you need to have IEC. In fact, to that much extent that even if you are exporting services, IEC is required to have any benefit coming through the FTP. So I'll tell you more about in detail when we talk about SEIS scheme. But as a first and foremost step, we'll have to check whichever client we want to deal with and we want to talk about FTP to them. The first and foremost step is whether they have an IEC code with them or not. IEC code is import-exporter code, which is a 10-digit code to be applied to DGFT, the authority that we talked about. The application form is under Form 2A, NF2A is called, and all basic information has to be confirmed. Yeah, we shut that off. Sorry, there's some technical difficulty. I'll just come back to it. So the basic details of the businesses, proprietors, partners, directors, etc. has to be submitted, and obviously the digital certificate is also required to be submitted at the DGFT. It's not more than a 5 to 15-day job to get this number in place, but that's the way IEC number has to be generated. Most of the important points for IEC, as I said earlier, it is for importers and well as exporters under the Act. The importer or exporter of services both are required to have IEC number if they are availing any benefit under FTP. So while I will talk about what SEIS script is all about, one of the relevant aspect of SEIS script is there is a huge rejections happening of permissibility of the script by the exporters of services because they did not have any IEC number with them. So if we have to apply for any SEIS script, the very first ground which the government is taking up is that the authorities, whether you have an IC number with you or not, and if you don't have it, if your client is not possessing IC code, there's a huge rejections happening. While conceptually I agree to all the thought processes which are running right now on this statement, is that if you're an exporter of services, why would anyone stop to give you a benefit if you in the end are getting foreign exchange into India? And the script value and the calculation is all perfect and robust. But yes, there's one procedural requirement, which is having this IC number by them, hence the rejection. Second, obviously, would be same as PAN number. So again, it's not a would not be any new number to be remembered as such. And one more important aspect would be it should be applied for all the branches and the divisions where your offices are, including the warehouses, the units, or the factories which are in India. I start off with the first script, which is merchandise export from India scheme. Now, MEIS script is per se a script which is very relevant from the perspectives of exporters of goods outside India. We have to first of all go to the background of the script. The background of the script is basically, it says the policy states that it is a reward to the exporters to offset infrastructural inefficiencies and associated cost involved by way of issuing the scripts on the export of goods outside India. What it intends to say is that if you are a exporter, if you are a person who is manufacturing, or if you are a person who is exporting any goods from India to outside India, there are basic inefficiencies which are already creeped into your business because of the infrastructural facilities which you are working under in India. And to reward you back because of the inefficiencies that a developing country is having, which is India, you are getting this benefit. That's what the background of the script is all about. Having said that, it is applicable to all the exporters of goods, and intention is to manufacture and export the notified goods and products outside India. When I say notified goods and products, that would mean that only those goods which are fitting under the policy, where the exact HSN, Harmonized System of Nomenclature, HSN classification has been allocated, though only those goods, if they are exported outside India, the MEIS script will be applicable to them. The way the entitlement is calculated is based on the realized FOB value of export in the free foreign exchange. So whatever the value of exports are, the FOB value, that will be the value basis which the MEIS entitlement will be calculated. Let's say an example, if you are exporting a very simple 1 lakh rupee of export of goods, and if you are realizing say 99,000 rupees free foreign exchange, the value, the entitlement of MEIS would be based on 99,000 rupees, not on 1 lakh. So that means that whatever money is coming into India, that will be the base number on which the entitlement will be coming up. How do we calculate will come on the next slides. When we have to apply for the script is 12 months from the LEO date, which is the let export order. So within 12 months of that order date, the application of MEIS has to be submitted. So let's again take an example. If the export is happening in the month of January 2018, within 12 months of that day, for example, 31st of December 2018, idealistically, this application will have to be submitted. So the gap given by this FTP policy is basically to ensure that the correct realization is done by the clients, and hence you can apply basis that realized money, and you can apply for getting the script from the DGFT officers. 3 months from the date of, again there's an option wherein it says that 3 months from the date of the uploading of the EDI shipping bills on the DGFT is also there. So whichever is later is the date when the permissibility of MEIS script would be there. Important aspect now, what are the rates of MEIS? Again, depending on the products, the classification of the HSN classification, the rates are different. If we see, the rate is 2 to 4% changed, 3 to 5% change, and 5 to 7% change very recently. And also, it got amended only after implementation of GST. So they have awarded more, the rates are more, and it got implemented from 1st of November 2017, the new rates. So it is very important what is written in the bold there, that will be 2 separate rates applicable for 17-18 as an application. So let's take an example here, friends, that if we are exporting say 1 lakh rupees of the value, and we are realizing 1 lakh rupees of value, that is the MEIS entitlement value, and our goods which we are exporting is classifying under 2% before 1st of November, and after 1st of November, or rather from 1st of November, on 4%. What we have to do is the bifurcation of 1 lakh rupees, whichever it is, we'll have to apply for 2% for the value. Say, for example, 40,000 out of 1 lakh is exported before 1st of November. Then on 40,000, 2% will be applicable, and on balance 60,000, 4% would be applicable. So the enhanced rate would be applicable on the goods which are exported after 1st of November, and that is the rate which will be applicable for the entitlement. So whatever is the percentage, that is what is the calculation that we are saying is the amount of the script that you will get. So if you are understanding this in a detailed manner, what we are trying to say is 4% benefit is given immediately to you on the value that you are receiving from the foreign exchange. So if we extrapolate this information to various industries, I will not be wrong to say that various net profit margin is also not 4%, or it may range from 2% to 10% from various industries. We're trying to say that to our clients that we can directly help you to increase your net profit by having some minor consultancy cost or time cost of getting the script into place, and the huge 4% benefit can come to you immediately. That's something which we'll have to ensure that whoever is exporting goods are validated, and we are checking from the FTP policy whether those goods are getting captured in that list, and ensuring that if it is, then we don't waste our time and we ensure that the script is applied for. There is no situation where you will lose anything if you have to apply. Maximum what will happen is your application may get rejected, but that's fine. If you are able to give your clients a 4 to 7% benefit immediately, I think anyone would love to get into this zone and try availing the benefit. And more important, if you see the box on the same slide below, until 4th of May 2016, exports which were made only to specific countries are eligible for the scheme. So there was a two-layer check that used to happen. One is on the type of goods and the HSN classification, and second is also on the countries where it is exported. The good news is that, and it was bifurcated into 3 groups, group A, B, and C, basis which the rate were decided. So for example, if it's going to a developing country, it's going to a developed country, and various other perspectives were carried on to ensure that the right benefit is given only if it is exported to the specific listed countries. Now, from 4th of May 2016, this list is completely gone away with. So there is no restriction for you if you are exporting to A country or B country. It is completely derived on the classification of the goods that you are exporting. So if the HSN classification is mentioned on the MEIS schedule, then it's a time for you to evaluate and go ahead and apply for it. So definitely relevant for all of us to ensure that this validation is done and application is done immediately. I'm sure some questions are revolving in mind on which year I should apply, when should I apply, how should I apply, etc. Obviously, we by now are aware about how and what has to be calculated, how the entitlement is done, and when to apply. I also have one good news which I will come in next slide, is which all years will be applicable for this, which we will take very soon. The key points for making MEIS application is one, the declaration. Again, this is a procedural in nature, but we'll have to ensure that the shipping bills are etc. mentioning this intention of claiming the MEIS benefit. So henceforth also, I mean, I'm sure at the back end can't be amending the shipping bills now, but again, it's a procedural requirement. For future, if at all there is an evaluation done and your clients are going to apply for the MEIS script, then immediately declarations has to be started to put up in the shipping bill. Application again is a normal statement which is there. Form ANF 3A and 3D is what you have to apply for. Again, what is relevant is it will be a port-wise application. So the port where the exports are happening from will be the place where the application will have to be filed. And one more relevant point is one application will have to be filed will include maximum only 50 shipping bills. So if your clients are having 45 shipping bills in a year, no problem. it can be filed under one script. But if it is say 80 shipping bills that you have over a period of 1 year, then 2 scripts would be required. One is covering 50 and the other is covering 30. Sorry. I would also take some of the common points for MEIS and SEIS script, for example, which all years we should be applying for together. So right now, first we'll take up the next scheme, which is service exports from India scheme, and then we will have common points for MEIS and SEIS. Again, likewise in MEIS, we talked about all exporters of goods coming to exporter of services. Again, the FTP policy is not going away from benefiting them. Exporter of services has always been focused. Specifically, if we go back to 2009, 2006, and huge amendments happening, the refunds available. In fact, the recently refund fortnights under GST, which was made available. Huge focus is there by the country, at least specifically from Ministry of Finance, from GST side, but not only from that perspective. Even Ministry of Commerce is benefiting the export of services through SEIS script. Now, again, important part, if anyone is thinking right now at this point of time, is if you're claiming refund of GST, or if you're claiming refund of GST for the non-LUT matters or for the unutilized credit, you're already taking some benefit under the Ministry of Finance and the refunds are available to you, that you can still go under SEIS script. The answer is very clearly yes. So if you are exporters of services and if you are fitting under the SEIS scheme, definitely you should be claiming the script value immediately and apply for SEIS script. The work that is happening within GST framework is not linked anywhere within the Ministry of Commerce, and SEIS script is available whether or not you have applied for refund under GST. One of the important aspects that people always think about. Coming to SEIS script, what is it all about and how do we calculate? SEIS script was introduced in April 15. Again, the new FTP policy announced it. The earlier policy was called Served from India scheme, and now it is Service Export from India scheme. The logic is again to incentivize the exporters of services, and the calculation will be very similar to the MEIS script as well. So the entitlement first has to be calculated, and once the entitled calculation is done, the percentage is directly available as a script value to the exporters. So if you are again in the exporting services and you are exporting services worth 1 lakh rupees for 18-19 as a year, then 4%, if your bracket is sitting in 4% of 1 lakh rupees directly will be available to you as a script value. One more important aspect is the minimum net foreign exchange. If we see the value again, most of our clients will typically fit under this entire year. If we have to calculate together, the minimum net foreign exchange value is USD 10,000 for individual service providers and proprietorship, and others it is USD 15,000. So consolidated amount for the year, if we crossing this threshold, the refund or rather the script is available under the SEIS script scheme. Last day of application shall be 12 months from the end of the relevant financial year for which the claim pertains to. So let's again take an example of say 16-17 as a year. 16-17 as a year, the year gets over on 31st of March 2017. So the claim has to be applied from 12 months from the end of the financial year. The intention is that you would have exported 16-17 as a financial year, and you have entire 12 months to apply to ensure that the money is coming into your account. You have received your foreign exchange value, whatever is required under the scheme, and you then apply at one stroke for the entire year within 12 months. The intention should also be that the audit and the finalization and the books of accounts should be closed, because that is prerequisite to be submitted along with various documents to file along with this application. And the faster you recover money from your clients, overseas clients, the faster you can apply for the script is what the backdrop is. Procedure for filing the SEIS application is we have to, as I said, you have to apply and get IC code immediately. So today, if you're applying for 16-17 as a year, and if you don't have IC number for 16-17, most of the application at the DGFT level are getting rejected, that procedurally you are not complied with hence it is not a valid application. So only if you apply for IC, then immediately SEIS script application is getting processed. The first very step that they validate. Having said that, various people have different views. Procedure, it is a procedural in nature, and substantive benefits cannot be denied under the schemes, etc. is all getting litigated. At this juncture, I would not give a view, what is to be done. But what is relevant is that if IC is not obtained for your exporters or clients who are exporting, then definitely apply for it because it's required under the law. Obtain the digital signature, again obtain RCMC certificate, again one of the important aspect which is required to get it from DGFT, a procedural in nature, but it will take almost 20 days idealistically to get this certificate in place. The others are all procedural in nature, the way we see 8 to 10 relevant pointers. The sixth point is important for us as a profession is obtaining a CA certification. So CA certification is nothing but certifying that what they have exported, what is being disclosed as exporters, and what is the money that they have recovered is all coming in one certificate, and we certify that this is the value or entitlement on which the percentage should be calculated on. Why it has been obviously given this is basically they would need someone, a third party, to come in and validate the value, because otherwise the script could be taking a way wherein it could be not used appropriately by malified intention, and hence a certification is required, and they really rely on such kind of certification, which is a mandate under the law. One points which we discussed, which I was talking about, few points. One is ineligible categories. Supplies made from the DTA, the domestic tariff area units, to the SEZ units and the deemed exports are not going to be benefiting the MEI script. Intention is again or logics in place that they want the goods to go out of India. So if it is going from DTA to SEZ, or there are deemed exports benefit, on the EOU or STP front, then they want to very clearly not give the MEI as benefit to the deemed exporters. Export of imported goods covered under paragraph 2.46 of the funded policy. These are basically the export of imported goods in the same form, substantially the same form. That means a trader, importer trader, basically, if you are importing some goods into India and then exporting outside India, then MEI script benefit will not be available. And the reason is, again, they want to promote the manufacturing facility, want to promote Make in India. They want to ensure that if you are doing some activity in India, it could be a value addition. It is not mandatory that it has to be manufactured, but a value addition is done, then 2.46 paragraph will not hit you, because it says in the same form or substantially in the same form. Exports through transshipment, meaning thereby exports that are originating in the third country but transshipped through India. These are typically called drop shipment. If I'm in India and I want to, I have a supplier in Germany and I have to export it to Malaysia, then what I would typically do is in two forms. One is, ideally I will ask Germany supplier to supply directly to Malaysia, or I will ask or I will ensure that the importation is done into India and then again exportation is done to Malaysia. So in that example, again, there is nothing happening per se in India, and hence the benefit of MEIS for these drop shipments are not available. SEZ, EOU, FTWZ products exported through DTA units. Again, what they're trying to say is that if you are an DTA unit and you are procuring from SEZs and then exporting it, that will not be eligible for any benefit under MEIS. Exports made by units in FTWZ. FTWZ we all are aware about is a free trade warehousing zone. The intention of this FTWZ is very clear, that it's a trading hub. They want to promote trading in India by giving the warehousing zones, wherein you can import into India and you can directly trade and sell goods outside India by keeping the warehousing in India in these specific zones, wherein the taxes or the benefit is available to you, or the taxes are not hitting you. But exports made by such kind of units again would not be benefiting under the MEIS script. SEIS script, the 3 pointers are very common and obvious rather. One is the equity or debt participation. So these are the revenue, or rather the consideration, or for that matter even the income, or rather, the money which is coming in. I will not say income, but money which comes in into India through donation, through repayment of loans, or a debt or equity participation, that is obviously not applicable for benefiting under SEIS, because there is no service happening. The concept is very simple in that form. Now, important update is application. While there is a time limit which we mentioned earlier for MEIS and SEIS both, if your clients have not applied, and procedurally if you are able to handle it, it is important for us to know that the FTP policy also gives a benefit that there would be a typical percentage cut, which is in a form of a late fee, if I can call it, which will be deducted from the value of the script. But still, the good news is that you can apply. So it's like, if nothing is there, it's good that you are having something. If it's already 2 years down, the 10% late cut would be applicable as per the policy. Again, if I take my example, 1 lakh rupee and 4%, which is 4,000 rupees benefit. And obviously, if we have say 10 crores or 100 crore rupee of turnover, we have huge numbers to talk about. In that 4,000 rupees, in my earlier example, 10% of 4,000 will be cut, which is 400 rupees, and 3,600 will still be applicable, even if you have not applied and if you are applying it in a delayed manner. So, most important aspect is, whilst we are sitting today, in the year 2018, it is important that we calculate for all our clients who are eligible for such kind of scripts, from what date it will be applicable, how much it will be applicable, what is the late cut that we have to pay or deduct from the script value and apply from the DGFT officers. So even for the year 15, 16, 16, 17, definitely it can be taken up as a calculation, and application should be filed for our clients. The most of our clients may not even be aware about it, or even if they are aware, they would have never calculated how much benefit is coming in, and it's the right time for us to stand by them and get the application submitted. With a late cut, no problem. There's one recent announcement which happened only 2 days back through public notice dated 28th of June 2018, which said that supplementary claims for duty scripts under SEIS and MEIS would not be admissible. So what happened is, various times there were applications which were submitted, and immediately after application submission, there are deficiency memos which the DGFT officers were issuing. Now, whilst this deficiency was issued, there were times when supplementary claims were also getting submitted by the exporters. Let's again take an example. If you are exporting, the calculation is all done, and you apply for an export of 1 lakh rupee and with a 4% benefit. Suddenly you realize that whilst calculating, we missed out say XYZ number of invoices, and say 20,000 of value is not captured. So supplementary claims were submitted by the industry, and a script value was enhanced by them in the application. Now, there was no law which very clearly mandated officers to reject such kind of claims, and there came the problem of whether such kind of application is permissible or not. More likely than not, it got rejected earlier as well. But having said that, now it is very clearly spelled out that such kind of claims are not going to be entertained. So whatever is supposed to be applied is applied appropriately with all due respect to all the documentation, and ensure that the first stroke is done in the perfect manner to ensure that there is less of to and fro happening from the department side. And we have to also remember the department angle from it, that it's a direct exercise of giving a value to the exporters without having any complication around it, because it's a post facto event. You have already exported, you have done the calculation, you have got the money, so there is no obligation that you are going to have after getting the script. So it's most important for them to ensure that the right kind of application is processed, because in a way, if I talk in our own language, this is almost like a cash back opportunity, and therefore it is important to do the checking by the department in a most appropriate manner. Common benefits, the immediate savings in payment of taxes. So the schemes grant the script as a percentage of the NFE, and it's obviously going to be used against your importation activity. So if you are importing goods, and if you have to pay the basic custom duty, immediately these scripts will be useful for you. You will not have to pay any custom duty of basic custom duty to the custom authorities, you will just use the script value. Let's again take my example. If you have a script of say 4,000 rupees, if you have to pay 500 rupees of custom duty, the script will be used. You will reduce the script value from 4,000 to 2,500, and 500 of custom duty will be deducted from there. And hence, there will be no cash outflow for your client to the custom officers, and there is no payment of basic custom duty to be done. Having said that, obviously there would be few clients, for example, people like us who are providing services, but we don't have any plan of importing any goods, so there is no basic custom duty being paid by, or rather being liable to us. So what do we do with the script? Do we really need to apply or not is a question that may come in. The answer comes in the second bullet. It is freely transferable. So if at all you are an exporter of XYZ services which are permissible under the SEIS scheme, you please apply for that scheme for your clients, for yourself. Get the script in place. Once you have the script, it is easily transferable to any industry player. People who are continuously importing goods into their business, who are importers and who are traders, who are need to pay basic custom duty on a routine basis, they are definitely going to purchase the script from you. Benefit to them also I will explain, but the benefit to you would be the first step. You will directly get your cash in place. So if you have a 4,000 rupees script in my example with you, almost I may say, as low as 90% on as high as 98% is the value which runs in the market. Obviously there are ups and downs around it, but even if we have an average of 90-95% return direct into 4,000 rupees, that value of cash will be given by the purchaser. So that's something which is very important, because you will get if we apply logics, it's directly cashback is what I was talking about, is selling the scripts in the market. Now the benefit to the purchaser would be that if he has to pay say 100 rupees of custom duty, he has procured a 100 rupee script from you, he would be paying only 98 to you on the valuation and the way industry norms are. It could be, as we discussed, from 90 to 98, any percentage based on the negotiation also. So even if they pay 95, 98, there is a benefit of 2 to 5 rupees or to the extent of 10 rupees that he would be enjoying, because he will be using the script value of 100, paying only XYZ amount to you based on your negotiation for your client, and he will be also benefited. So there is always a benefit applicable also for the purchaser and also for the seller, and hence the trade of these units are very common and very quick, very quick. It is relevant point is that it is valid for 24 months. Earlier it was 18 months. Now it has been extended to 24, which is 2 years from the date of issue. From when the DGFT officers would be issuing the script. Now, how do we utilize the basic? It will be utilized against the basic custom duty and the additional custom duty. When you're importing, you'll have to ensure that the set off is done against the script value, and you can utilize this against the duties that is to be paid on the custom front. Also, excise duty, where it is applicable even today, like alcohol and petroleum products, it can be used. These scripts can be used if by any chance you are into procurement of these goods. For example, if you are into a pharma industry, then content of alcohol is always procured. Even for that matter, various industries, this is required, and where excise duties are liable to be paid, then you can use these scripts to set off the liability or duties that you have to pay on the procurement side. GST, I will say it's not a bad news, but it's very clear now. Good news is that there is no ambiguity around it, but only point is these scripts are not going to be utilized against GST. And this again is a concept which is run because of the fact that GST is a Ministry of Finance baby, and all these scripts are Ministry of Commerce baby, and they don't want to intertwine the two concepts. They want to ensure that the benefits are given to the relevant stakeholders and there is no complication around it. So no benefit of setting off of these scripts are available to the people who are having GST liability on the procurement. GST on sale, a very good graph which we can see. If we see GST rate before 9th of September 2017, it was 12%, which was announced. Good amount of representation was submitted at that point of time, and after or rather with effect from 9th of September, the rate got reduced to 5%. And Again, after that, a decent amount of lobbying was done to ensure that the benefit which is available to the exporters cannot be taken away by charging GST on selling those scripts, and hence from 13th of October it is very clearly exempted. The selling of the scripts are clearly exempted under the GST law effective 13th of October. The only point here would be relevant again from the GST side is because it is exempted, it will call for reversal of standard credit, or the input credit, I will say, and hence you will have to ensure that while the value will be as very high as you can imagine based on your export, because it is an exempted supply, there would be reversal of credit that you will have to ensure your clients are conducting. Now move to the third step, the scheme, which is advance authorization. Advance authorization are the duty-free imports required for inputs. So typically a situation wherein you are an exporter of goods and you require inputs to make the exporters manufacture the export product. In such situation, you will require to input, you will procure inputs which are going to be used in manufacturing such goods, which are going to be ultimately exported. Again, if we see the bifurcation or thought processes, this script is called advance authorization is because you are asking for getting a script or a scheme before exporting, because of which it is called advance, and it's a pre-export benefit. So you are technically claiming a benefit for procuring inputs which are ultimately going to be used to export the goods outside India, and hence it is called advance authorization. Also, it is applicable if you have the script. You can invalidation process is called, invalidate the advance authorization script and procure the duty-free inputs which are local procurement. So the slide which you have in front of you, the duties which are going to be exempted is all the basic custom duty and the additional custom duty and the cesses and the social welfare charges, etc. Which are going to be exempted if you have this script with you. The only point here is, you will have to have an export obligation around it. The next slide is talking about the 4 major conditions for anyone to apply for the script. Is one, it is an actual user condition, which means that goods which are imported are not transferable. Let's say I import say batteries, and I say that these batteries are going to be used in manufacturing a remote, okay, and I have to export these remotes. Whilst importing these batteries, I realized that I can also trade in these batteries and sell it to someone else who is making not remote but a laptop. I'm just giving a random example. So that activity cannot be done in a manner wherein I import duty free, but give it to a person who is ideally going to export or not going to export, but going to not manufacture the goods which are planned to be exported. So that means it's an actual user condition. You intended to export XYZ goods for which you procured ABC inputs, for which you took advance authorization, then you are the user and you have to follow the actual user condition. That's the number 1 step. Number 2 is it's based on the standard input output norms, which is called SEIS. That means that whatever inputs are going to be used for the production of an exported good, it has to be fit under the input output norms. I cannot say, let's again take my small example. I cannot say that I have to manufacture remote, which is a TV remote, and I need to have the batteries, which is 2 batteries a remote. Now the standard input output norm would say that 2 batteries per remote is permissible. I cannot import say 40 batteries for manufacturing 1 remote. So for example, for that perspective, the norms are very clear. What is the product and what is the input that is going to be used, and it is so detailed manner that they also give percentages what all inputs are required to produce any output within India. So it is very clearly mentioned out there. You may also have some clients for which the products are not mentioned in the SIN or standard input output norms. For that, you have to apply with them. And once you apply that your product is this, your technicalities are this, and your inputs are going to be this, they will notify that yes, your condition is validated and checked. And within the SIN network, you are going to ensure that it is permissible for you to apply for advance authorization. So if your product is not listed, you can apply, and if it is listed, you will have to follow the rules to ensure that the correct input output norms are followed. Import to be completed within 12 months from the date of issue. So if you are going to apply for advance authorization, you have to ensure that the imports are completed. You can't be having a long stretch of say 3 years of plan of importation. Within 12 months that from the date of issue of advance authorization certificate, the import has to be completed. Export obligation should be fulfilled within 18 months from the date of issue of advance authorization. So if we see, it is good amount of work or calculation or projections will have to be done so that you are able to calculate, use the script and also fulfill the export obligation. So in a way, what government is saying is you have 12 months to import, 18 months to export, but both are from the date of issue of advance authorization. So if you are importing late, then your impact would also be there if you are not going to be exporting it on right time. So you have only 6 months gap between the two if you are importing in the last day. So idealistically, you have the advance authorization only when we are nearing your import. Import in 1 or 2 months so that you have a bandwidth of 15 to 17 months to ensure that the export obligation is fulfilled. There are again some few important aspects which we would like to talk here for advance authorization. One is the minimum value addition required, which is 15%, a calculative method wherein they are saying that if you're inputting into something which is going to be used in an output product, there has to be a value addition minimum of 15% that you have to do. You cannot import something and use this as an input wherein it's same as the output product, very same. So substantially is the word which they typically use. So hence 15% value addition is mandatory required. Export obligation is on completion of exports, and we have to submit an application in ANF 4F to ensure that export obligation is discharged and is completed. So the process is completed, we have met the export obligation and there is no formalities which are pending. Important aspect is the third one, penal action in case of non-fulfillment, which is a case which happens not frequently, I will say, but many times. The value addition, not fulfillment of the export obligation, then the 5 times of the CIF value of the imported material will be a penalty which would be applicable. So a huge amount of penalties can come into picture if there is any mistake happening from export obligation perspective. In practice, people have actually also seen that if suo moto, if you are able to see that export obligation is not met, because it's not only about your client manufacturing those goods, it's also about the economies and the demand supply concept of the same product, which are not which are you are dependent on. Then in such a situation, there could be situation where export obligations are not met, and in that scenario, if you suo moto go to the department and say that this is not the time, either one, condone the delay, or two, we are ready to pay the upfront interest and the import duty, please ensure that there is no penal action against us. Then there are situations we have experienced that penalty is waived off. Export promotion capital goods scheme, the next scheme that we are talking about, the name suggests it all. The export is promoted, and the promotion is happening from the perspective that you are importing capital goods. So that's the basic scheme that we are talking about. The objective is to facilitate import of capital goods without payment of duty. Obviously, this is running very well from the Make in India initiative perspective, which India is working on. The export obligation here is 6 times of the duty saved, but the time that is available, because the capital goods value would be very huge, and from that perspective, if custom duties is waived off, it has to be ensured that you have adequate time to ensure that export obligation is also met. Let's say an example, you are say importing a capital good worth 10 lakh rupees, and your obligation would be your duty saved, which is probably say 10 rupees if you are calculating basic custom duty. So 10 into 6 times will be what the export obligation would be. Because the value would be so huge, you have 6 years time to ensure that you are fulfilling the export obligation. Idealistically, the thought process is the way amortization happen, the export should also be meeting the deadlines over a period of 6 years. Again, there are applications which get filed on extensions, on condonation of delay, etc., but which obviously is on case-to-case basis. One of the important aspect on the third box which we are talking about is the subject to actual user condition, which is the exporter who is going to take the benefit of EPCG and going to import capital goods without payment of duty, have to ensure that till the time he is meeting the export obligation, capital goods are owned by them and used by them to ensure that the exports are done. After the obligation is met, they are free to either sell or dispose of the capital goods. Before that, it is not permissible. Authorization is valid for 18 months, which is fine. Deemed exports are again some of the benefits under FTP, which is given under Chapter 7. Okay. Mr. Hiral has just come in, and sorry, previous slide would mean the example would. But example as in what the value wise you want to mention? Okay. So Mr. Hiral has just come in and said that there is one request came in wherein we can give an example of the EPCG scheme. So let's say you are exporter of goods and you want to manufacture that goods into India. For manufacturing, say again in my example, say a mobile phone, you need a capital good for assembling all the the goods which are going to be imported or locally procured. And for such kind of situation, you want to the ultimate aim is to export the mobile phone, but for that activity you will have to import the huge capital machinery. So EPCG scheme says that you please import capital goods for exporting the mobile phone, which would be used for you to manufacture such mobile phones. And for importing such capital goods, there is no duty that you have to pay. Now let's put an example on numbers on these. You are exporting or rather importing 1 lakh rupee of capital good into India, on which 10,000 rupees of custom duty is liable to be paid. The EPCG scheme says don't pay this custom duty, let the capital goods come into India, no problem. Once the goods come into India, your export obligation becomes 10,000 into 6 times. So 60,000 rupees of export obligation comes into your requirement as per the scheme. Start manufacturing the mobile phone and you start exporting that. And the day when you complete 60,000 rupees of export of mobile phone, your export obligations are met. So what we have to do is we have to apply and we have to get the script. Once we get the script, use it for the importation of the capital good, and then update on time to time basis, on year-on-year basis, on how much export obligation you have met. So if for first 2 years, because we also need to understand that once the capital goods are imported, there's a huge time typically it takes for setting up. So setting up may itself take a year or two for you to set up and manufacture the manufacturing facility, and then you also have to ensure that the demand is created for a product and supplies are done. So first 1, 2 or 3 years you gradually start exporting, and huge business may not be done in that manner. But the projection should be very clearly shown at the time of EPCG application itself, that in a period of 6 years, how are you planning to ensure that the export obligation is met. So that's the basic fundamental thing that we talk about under the EPCG scheme. There are also a scheme within EPCG subset, which is a post-export EPCG scheme, which I'm not taking in detail. But if you are an exporter of goods and there are expansion plans for you, you can also take a benefit of post EPCG benefit, which is you import capital goods on the benefit of the export that you have already done, which is an important scheme per se, wherein you don't have to have an export obligation, but will have a benefit of capital goods being imported duty free and still benefiting the exports that you've already done. Obviously the percentage and the calculation are different from the routine scheme, but that is a scheme which is available within the EPCG subset. Deemed export, we have a concept of deemed export. So if you see the second heading, supply of goods against authorization, advance authorization, or against EPCG authorization, or to EOU, STP, or BTP, all these are when made by a manufacturer, it is supposed to be understood as deemed exports, which means that the policy allows or is treating the supplies made by a DTA, which is domestic tariff area manufacturer, to take the benefit of exports when they are supplying to such kind of purchasers. So while it is not leaving the land of India, it is within the framework of India, but still deemed export benefit would be available. What is the benefit is will be eligible for FTP benefits, obviously, we read on the ineligible categories. MEIS is per se not eligible under the FTP, but various scripts or various schemes are available under the FTP for deemed exporters as well. And the benefit of deemed export, drawback of BCD is obviously available. EOU, again, an export-oriented unit. FTP policy also has a chapter on EOU, which typically is a unit which is exporting, or rather the intent of this unit is to export all the goods outside India. And EOU are obviously, very similar to SEZs, but it is not within the SEZ area. So special economic zones are zones which are notified and which are stipulated, while EOUs are not realistically in the same SEZ area, and that's the basic difference. Otherwise, the fundamental concept is both same, that they are going to promote the exports outside India, and EOUs are obviously one of the schemes available within the FTP policy, and obviously there are various benefits available from tax and non-tax perspective for EOU units as well. Trading units are not covered under the scheme, which is very relevant for all of us to know. The exemption available under EOU scheme is first till 12th of October. If we see the table, upfront exemption of BCD on procurement of imported goods was available. From 13th October onwards, the extension was also made available to IGST. So, it was very important for EOUs to have this benefit from GST perspective. Again, the huge Ministry of Commerce and Ministry of Finance matter. But yes, it was given because the scheme allowed EOUs to set up in a very big way. And it obviously had not only from tax perspective, from employment, from manufacturing perspective, from getting foreign exchange, etc. So many perspectives were thought through before setting up of an EOU and benefiting that was passed on to them. Now withdrawing some kind of benefit because the new law was entering India was not very logical, and hence from 13th of October 17, we saw a change coming in where an extension was also given to the IGST, and the compensation cess was paid, and the date which was announced which will be applicable was only 31st of March, which again got extended in the month of March till 2nd of October. So probably what we are trying to see is that the intent is not to give the GST benefit to the EOUs, but considering the stability which is required, they are trying to extend till the time they can, and hence not backstabbing the EOU or export-oriented units which was promised earlier. So till 2nd of October, there stands to be ceasefire as far as the IGST, BCD or SEIS is concerned. From 3rd of October, there's a question. 3rd of October 2018, how and what will be treated, as the time will decide whether there are any further extensions on the same or not. PI benefits, we discussed about the benefit of EOU will be the custom duty, which is fine. I think this is all what we per se discussed. One third bullet is excise custom supervision and control on sealing of export containers done away with. So, one of the important perspective very recently happened on the EOUs was a very strict supervision and control was there on the sealing of the export containers, which was completely done, and now a self procedure has been, suo motu procedure has been coming, that they have to seal the export containers, and in a very prescribed manner, the assessees themselves have to do this now vis-a-vis the supervision and control. So in a very simple language, Inspector Raj, which was earlier on this front, is completely done away with. Special examination zone. This is a classic work which we all are doing, and various of our clients are there. I would not want to waste your time in talking much about it, but we all are aware about the fact that it's governed under SEZ Act 2005. The Act has a notwithstanding clause to say that anything inconsistent to other law, the Act will prevail. Free trade warehousing zone is also a part of SEZ. So SEZ Act itself covers free trade FTWZ within the ambit of SEZ. So FTWZ, if we are talking about, is always an SEZ and is a subset of SEZ. SEZ shall be having a positive net foreign exchange, which is obvious. This one slide will help to see the benefit of GST on the SEZs. So if you see on the right hand side, there is an SEZ unit or a developer. When there is a procurement happening, all the three procurements that we see, one we see a supplier from outside India supplying to SEZ. There we see exemption from custom duty and IGST. So SEZ unit or a developer does not have to pay any custom duty or IGST. When there is a supplier from India, there is again zero rating benefit available. When the SEZ unit or developer is exporting the goods to a customer outside India, then if we see that it says zero rated subject to certain condition, which is fine. And when there is a DTA sales happening by the SEZ, it is liable to custom duty plus GST. So in a very layman language, if I say the SEZ unit or the developer, if we logically treat them as a foreign soil, then the treatment you will be very clearly understanding. So if we move the entire SEZ developer, the building that we are seeing, to a location outside India, then what the treatment would be somewhere, which happens within India as well. So if a supplier is selling goods or services to SEZ, which is outside, which is considered to be foreign soil, then obviously it has to be zero rated. And obviously the supplier from outside to outside also would be zero rated. If the selling is happening to a DTA, then it is supposed to be considered as import of goods into India, and hence we see chargeable of custom duty and GST. Very briefly, almost the last slide, we discussed various aspects, but let's just briefly touch upon how is GST on the incentives under the FTP. So the first point which is mentioned here is would be used for all the payments of custom duty, excise and service tax. Now it is obviously specified under 3.1, 3.3 and 3.5 of the custom tariff, and hence basic custom duty, whenever you have to pay, you can use the script. These scripts cannot be used for payment of IGST and compensation shares, very clearly point out. So no set off of GST that can be done by using the script value. Obviously we are not talking about transferability, that obviously we discussed, but wherever it is freely transferable, immediately cash entitlement is available to you. The goods covered under the central excise, the benefit is available to set off against that duty as well, alcohol, petroleum products, etc. The validity is for 24 months. And important aspect that we discussed earlier, from effective 13th October, the exemption is available for selling of duty slips. Yes, there will be a reversal of credit that will be required to be done. We are done with the presentation. I have 2 or 3 questions which I have put here, and we would be wanting others also to put in their questions in the chat box so that we can try answering them. Again, I repeat, if at all we are not able to answer because of the time or the technicalities around it, we will definitely revert to you over an email. So please put your email IDs also in the chat box so that we can reply to you over an email and ensure that your queries are resolved. A few of the questions which is in front of you, and then I would also like to take a few other questions which are already come up in the chat box. One, a company located in SEIS, we all are aware about SEIS, which is Andheri SEZ, is procuring wool from within India and outside India. It exports sweater to its major customer in Italy, annually worth US dollars 50,000. Will the company, being an SEZ unit, be eligible for MEIS benefits? Yes, export of goods directly from SEZ to place outside India are eligible to claim benefits under MEIS. What will be not available, if we saw the ineligible categories correctly, is supplies made from DTA to SEZ and SEZ products exported to DTA units. So first one is if DTA is selling goods to SEZ, they cannot claim MEIS benefit, the DTA unit itself. And if SEZs are selling goods to DTA and then DTA is exporting, that means it's a trading unit. Again, this benefit is not available. But SEZ units themselves, if they are exporting, the benefit is very well available to them. ABC and company imports goods from Germany and stores the goods in its warehouse. They export the same goods stored in the warehouse to various countries as per the order received. Total export turnover is $3,56,000. Appropriate declarations are made in the shipping bill. ABC and companies filing application of MEIS within the time limit. Will they be eligible to claim the benefit? Answer is no. The benefit of MEIS cannot be availed against export of imported goods in the same or substantially the same form, which is the para 2.46 that we referred for the foreign trade policy. One more is, can we file MEIS application for total 50 shipping bills pertaining to separate financial year in a single form? So what we learned is the benefit of MEIS is available, per application you can file for 50 shipping bills. Now your client may have say 50 shipping bills, but they are passing through 2 financial years, say 30 in one and 20 in the other financial years. What will you typically do? Will you apply for one script? Will you apply for separate scripts? What is to be done? Is the question. Answer is there is no specific disallowance, but however, the submission has to be done in 2 different application forms. So in the financial year, you will have to file for 30. The next financial year of 20, you will have to file for 20. But the contrary discussion is that if you have in the same financial year 80, then you have to file for 2 applications, 50 and 30, even if it is for the same financial year. So the cap is per application and maximum up to 50 shipping bills. And again, this is more practical things that we have seen while applying for SIP. So it is very important for us to ensure that right kind of research and validation is done before we apply. This is an SEIS question. SEZ, XYZ and company, a partnership firm, has a net foreign earnings amounting to $13,000 during the financial year 17-18. Whether XYZ is eligible for benefits under SEIS for financial year 17-18? No, a partnership firm to qualify for benefits under SEIS should have a minimum $15,000, which we saw in the earlier slides, that there should be 10,000 for proprietorship and individuals, and others are fitting under 15,000. So here I stand done with the presentation. We would like to take the questions. I would just take a minute or two break to read out the questions, and then we will immediately start answering them. There's a question. Okay.
Realization is made after. What is the date to be considered? It is 2% or 4%. Because after that, 4%. Okay. The time of export to shipping bill will be considered. So rate applicable rate is 2%.
Okay. So one question I have is a situation wherein do you know the name of this person? Okay, no problem. So one of the question is that if you are exporting and there is 2% applicable rate applicable, which is before 1st of November 2017 on the goods that you are exporting, but you receive money only after 1st of November 2017, where the rate is converted to 4%. Then what is the rate that will be available to you? Whether 2 or 4, because realization is happening in the era of 4%, but exporting is happening in the era of 2%. The answer is very simple. Whatever rate is applicable at the time of export, which is a shipping bill date, will be the rate which will be applicable. So in this instance scenario, it will be 2%.
Yes.
One of the question is MEIS can be used towards payment of custom duty. Yes, the answer is yes. And follow-up questions are that SEIS can also be used to pay custom duty. Again, the answer is very clearly yes. So for the service exporters, if you are into expansion mode or if you are importing any goods for your company, then definitely those benefits will be available, and the SEIS script can be set it off against the basic custom duty for which the importation is happening. Where else it can be utilized? Nowhere else, but yes, it can be claimed by transferring the script to a person who is importing, and hence it is directly a benefit available to cash with a lower percentage ranging from 90 to 98 as per your negotiation and the availability of your customers, but it can be sold in a manner and the money can come back to you very immediately. Oh, very important question. In fact, one of the good amount of detailing used to happen on the late cut fees, which we saw in the slide from 2% to 10%. And the question is, if the value of services is say 1 lakh and the value of the script is 4,000, the 2% cut is on what? For example, if we say 2% cut is on the value of services, that means on 1 lakh rupees 2% is cut, then means that the SEIS script directly reduces from 4,000 to 1,000. However, the value of late cut fee is not on the value of services. The late cut is on the value of the script. That means if you are exporting of services worth 1 lakh rupees and 4% is entitlement, then 4,000 rupees is your script value. The 2% cut will be on 4,000, which would be 80 rupees. So correct, 80 is the calculation. So 80 will be the 2% cut, and 3,920 rupees out of 4,000 rupees will be the eligible value if 2% cut is there. So it is not on the value of services, it is on the script value. One question is, there are various schemes available as we saw. If we see MEIS and SEIS scheme, if we are applying for it, the question is whether duty drawback can also be claimed. So if you are claiming MEIS, SEIS or advance authorization, and duty drawback be claimed. As per the law, what is available under FTP, there is a barring principle as far as advance authorization is concerned. So if you are applying for advance authorization, duty drawback cannot be claimed and vice versa. But if you are applying for MEIS or SEIS, duty drawback is still available to you.
There are differing rates for that?
No, sir. No differing rates. Please share it with us. Okay. When IC code is not taken for service export, then there will be no ITC, whether we can now register and apply for FTP. Okay, the question is coming from Mr. Vikram Mehta. It says when IC code is not taken for service export, there being no ITC, whether we can now register and apply for FTP. Mr. Vikram, I understand your question from the perspective that you are an exporter or your client is an exporter of services, and IC code or the importer-exporter code is not been applied. Obviously, for exporter of services, other than this benefits, there is no requirement to have the IC code, and hence your clients or you would have not applied for it. And the question that you are having is whether you can now apply for it and claim for SEIS benefit. Answer is not that straightforward. Answer is yes. We recommend you to apply for IEC. Apply for condonation of the fact that IEC was not there for the period of export, and late cut is calculated accordingly. And you apply for SEIS script also after getting the IEC number. You cannot apply for SEIS without having application of IEC and RCMC. So it is mandatory for you to get all these documents in place. Yes, it is a procedural lapse. But again, we have seen in our profession that substantive benefit cannot be denied based on procedural lapse. So it's a litigation matter, and we'll have to ensure that all the procedural formalities are done with, and there is no harm in applying for. And if there is any rejections, you may always, check if there is any legal formalities or appealable way. We can go ahead and fight a case to ensure that procedural lapses are not denying your substantive benefits. Okay, one question here is coming from Mr. Narula. He's saying, I've exported some footballs to Taiwan. After reaching the material, buyer informed some footballs are out of use. There is some problem, and he has asked for some other footballs. Returning back of damaged footballs is not possible to call back from Taiwan because freight charges is more high as compared to material. He suggests what to do. Whoa, I think it's a clear business call that has to be taken here. But if I link your question to the foreign trade policy discussion that I'm having, I think, Mr. Narula, what you're trying to indicate is that you have exported, say, some footballs, and you are not able to get damaged footballs back. because of the freight charges, and the logistics cost is higher than getting it back into India, then what is to be done? From the perspective of FTP, the calculation will not have the coverage of these footballs which are damaged, because you will not recover money or consideration from your clients from Taiwan on the damaged footballs. So if you are going to export the footballs and recover money from your Taiwan customers, that is the calculation which will be base calculation for any entitlement that you want to claim under FTP. Okay, a very nice question coming in from Ms. Mahima. The question is, why are we increasing the benefits under MEIS when we might have to just withdraw the scheme if we lose the WTO challenge? Mahima, I think your question is valid as far as the concept is concerned, that if the World Trade Organization, the discussion which we discussed, that FTP should be benefited or not to India, and developed countries like US are the most against it as such, because they want to have the trade freely available across the globe. I think the question is, what policies we as Indians or as a developing country is making through Ministry of Commerce, and whether they can abide by it within the global framework. So while it is contemplated that there is going to be a good amount of bottlenecks in the speed breakers coming up in near future, the intent is very simple, that as a developing country we want to export more, because it's very clearly calculation from the fiscal deficit perspective or revenue deficit perspective. Even if we see the intention and the verbatim word used under the policy of MEIS itself, is very clearly mentioned that it is a value given back to the exporters for the inefficiencies on the infrastructure's perspective. So while other countries may have some queries around it, or may not agree to this, that there is no free trade happening, but the fact remains that free trade may happen only in a circumstances where every remains stagnant or constant. If the infrastructure is not supportive enough, and if you're benefiting for a person to export, ideally, conceptually, there should be no downside to this. So hence the Indian government fight or to promote these schemes will not go away, and hence they are focusing on way they want to do the business, and they want to promote the export till the time global framework does not allow them to. One question which is not coming from FTP perspective, Pranabhai, can I take a GST question also? Okay. Yeah, we can try answering it if I'm understanding it well. It says, it's coming from Mr. Narula again. It says that I have purchased some goods from Dubai and sent the same to Taiwan. Retailer has never entered into custom frontiers in India. Will GST be applicable on this? Answer is, according to us, I'm sure you will have to see whether the nitty-gritties are correctly done, but this is again a drop shipment that we are talking about. The goods have never come into India, and hence place of supply does not get triggered. Such a situation, GST idealistically should not be applicable. And if I remember it well, there are also advanced ruling on this matter, which clearly says that in such kind of situation, there should be no GST being applicable. It is an out and out supply which is out of scope of GST. And one of the relevant aspect is also, because it is out and out scope, not liable to GST, you will have to see how are you treating your credits. Are you reversing your credits appropriately or not, is something which a position has to be taken off. A question coming from Mr. Umang Talati: can SEIS script purchased from market be used by an importer of goods? Note, he is trader in goods only. So what I understand here, Mr. Talati, is that your client is a trader, is importing goods into India and selling those goods into India. Meanwhile, they wish to purchase the SEIS script to use the script against the importation activity. The answer is very clearly yes. In fact, schemes are using such kind of activities, which ensures that your client of such nature are benefiting the value of the script. So in my example, if you remember, even if the client is purchasing this SEI script of 100 rupees by paying say 95 rupees to your the SEI script holder, then 100 rupees of basic custom duty benefit would be available to them. So there is a net saving of 5 rupees coming into the purchaser, the client, who will be using the script value against the payment of basic custom duty. Nabai, I think I'm done with all the questions.
Take that one second.
What is the meaning?
Whether from SEZ to SEZ, if there are any transfers of GST.
Okay, from the GST perspective.
Yes.
Okay, so one question which Pranavai has got from the participant is that there are various situations or a table which very smartly has been drafted, on the sales happening between two units. So, and the question is whether GST should be applicable on this or not. The various tables, sir, is covering when there's a supply happening from SEZ to a SEZ unit, SEZ to a EOU unit, which is a deemed export, again benefit, SEZ to an FEWZ, FEWZ to SEZ, or FEWZ to EOU, and vice versa. All these, the above which we said, which includes EOU to SEZ or EOU to EOU, all these situations are, in our view, GST would not be applicable. So the reasons,
because all these would be considered outside India.
Correct. So all would be considered to be foreign soil. I'm just saying that the reasons would be, per se, the notifications would be a little different for all, because specifically if you see SEZ, the zero rating benefit is available, whereas if you see EOUs or BTPs or any other benefiters, deemed exporters, there it is not zero rated immediately. It was structured manner that they enjoyed the benefit. So the notification is different, but the answer is GST is not applicable to sale happening within these units.
But now, as on date, all this will be considered as zero rated only.
Yes.
Now all will be considered as zero.
Yes.
So there is no reversal which is going
completely.
to happen.
Yes, that's what the position is all about. Thank you so much. I think we are done with the questions. Any further question, Hiralji, can I ask them to write to you for any further questions? So please. So Hiralji would just give an email ID on which you can please put your questions on. We wish to answer many more. Foreign trade policy is something which we cannot be completing in 1.5 hours. So Hiralji, if you can just put the email ID to everyone, I think it will help us.
Yeah.
All our any queries could be sent to stpam2@gmail.com, and we'll forward it to the speaker and we'll take it ahead from there.
Thank you, Jigar Bhai, for a splendid exponent of this MEIS, SEIS schemes, the FTP policy. I think very few of our members would be directly dealing with those, and it would be a very good learning experience for all of them, and you have explained it in a very nice way and also dealt with the various queries. I'll now request Hiral to make a few announcements, especially regarding the webcast that is going to happen day after tomorrow on 4th of July. And of course, a well-deserved vote of thanks to Jigar.
We would be on Wednesday. We would be having on 4th July. We would be having the mega guidance cell at our Masgaon library. The live streaming thereof is available. The link is available on our website, and it would be circulated through emails and SMS also. So it would be of great importance of understanding the department officials would be coming to explain the various glitches that are and glitches and stuff which is happening under the MBAT screening in terms of C-form application, revised returns. Those things would be explained in depth by them. Queries had to be sent by yesterday, but in case any queries are there, you can write it to our email ID. We'll try to speak to the department officials if they can answer that also.
And just to add to this, various issues had cropped up in the service cell meeting regarding the C forms to be applied for the earlier periods, the refund applications to be made for the earlier periods, filing of revised returns and J1, J2 mismatches for the earlier period, especially with respect to the new SAP system, which is now introduced since 2016-17 and is now fully operational. So there are various issues with regards to that, and we had approached the sales tax department officials, and they have agreed to come to our library. They will explain the various intricacies involved in making these applications, and various issues which are involved would be dealt in by them. And I would request the members to send in their queries at the earliest, so that these queries can be forwarded to the members which are going to lead that session. And if time permits, certain GST related queries would also be taken up. The issues in filing of GSTR 3B and GSTR 1 would also be taken up, or similar other such issues which are there. So kindly send in your queries at the earliest at stpam2@gmail.com. And one more thing, this mega guidance cell, which will be held at the GSTPAM Mazgaon library, would also be webcast at the various regional centers all across Maharashtra. We are already talking with the heads of the various regional centers, and they would be holding their study circle meetings, and possibly through screen and projector, many of our staff who are actually doing this filing of returns, etc., they will be able to view what are the views of the department, and gain in return from what they want to share on the screen. So I think kindly log on to that on 4th of July. The timings are from 1:30 to 3:30 p.m.
Yes, now the pleasant task of a hearty vote of thanks. All of you all would agree with me that CA Jigar Doshi has explained the various benefits under the foreign trade policy, along with the background of those schemes. To explain the background of the scheme, you have to have that entire confidence and the knowledge of how the schemes work. This shows his expertise. Though we do not have an import-export code, we have imported huge knowledge from him, and the import of knowledge has been without advance authorization. Sir, with this, I would thank Jigar Bhai for the pleasant session.
Thank you, sir. Thank you, sir.
Thank you, everybody.